Hello, Twitter. Hello, SMB Twitter. Hello, Tax Twitter. What I wanted to do in this video, I wanted to introduce myself, talk a little bit about who I am and what I do. And I also wanted to get into something that will add some value, I hope, and that's go through something that I can help out with, which is a deliverable with respect to some diligence around a transaction that was it was around 3 million, mid 3 millions, and there were some issue items and there were some concessions. And so I want to talk a little bit about that because I feel like in the small mid-sized business world that this is an area that is lacking in the process of acquisitions for many reasons. I would say that lack of knowledge, lack of awareness, also just lack of resources. No one wants to spend the amount of money that sometimes they could spend. So I'll talk a little bit about that and even talk about what something like that would cost if you were to work with me on that. So let me talk a little bit about myself. So my name is Joe. I'm a CPA. Been a CPA since 2012. I've had my own practice since 2017. If you go to jackcpa.com, click on purpose, you can see me and my team there. We focus on the traditional areas that you would focus on, tax and accounting. How I got to where I was is a story all in itself. To be long story short, I was fired in 2017, had $9,000 in my bank account, had a baby on the way, mortgage, car note, all of those things. And I had been praying about it before and saw it as an opportunity to take that step of faith. Felt like God was leading me in that direction, and He was faithful, and I've been successful. So we service around 100 clients. We're not a volume-based firm. We focus mainly on business owners and then their corresponding responsibilities that they have. So a business owner, obviously they file a business return and then they also file an individual return. So that's an ideal client, someone who has a business and an individual tax situation. But we do have a certain percentage of clients that is individual only. It would just have to be, maybe it's a referral or something that we're interested in. A little bit personal stuff about myself. I'm a family man. Okay. I also haven't drank in a very long time, 6 or 7 years. That's another story as well. I have 4 children. They are all in sports. I am fortunate enough and blessed enough that the 2 oldest ones that are of school age now go to a Christian school. So we have, our family value systems is Christian based, and I do tend to connect more with people who have that same foundation, just inherently. Telling the truth is one of our values at our firm, and I think it has a lot to do with that value system. I love to read. I'm a big fan of Jordan Peterson. I've read all of his books, including Maps of Meaning, which is a very difficult book to read. I'm now currently reading Jung, which is a rabbit hole all in itself. And I've read some Nietzsche. So I love to think. I'm a thinker, which is good when you're in the line of business that I am in. Some more about my experiences. I've worked at the big 4 firms, a big 4 firm. I've also worked at a large local firm. And then before my last run I was a manager managing around $1 million at a firm that now was acquired by Baker Tilly since then. And that's where I got a lot of my management ability and learned how to grow a firm, business development, those types of things there. So enough about that. I want to talk into a little bit more, get into the example that I referred to at the beginning regarding diligence and what that looks like and what that might result in, and then also what that might cost. So I'm going to try to remember that because I'm going off script here. I don't have a script here. So I'm going to try best to remember hit those 3 things. And if not, then please feel free to message me. And if there's something that I didn't cover and I was supposed to cover because I said I would cover it. All right, so let's get into that. So again, I think that this is an area that is typically missed, and it can happen during the LOI phase. It can happen after. Generally happens after because of the amount of information that's needed. But if you can do it before, that's even better. I just don't think that that typically would happen, because when you start requesting this type of information, they typically want to know that they're dealing with someone who is serious about buying the business. So I'm going to minimize this. I think my picture is going to fall off. I'm not sure what's happening with Loom. It's supposed to stay. I did say to share screen, but it's not. So I'm going to go ahead and open up the screen here, and we're going to get into all those nice details. Okay. Maybe I can put myself over here. All right. So this is a cheat sheet. It's an oldie but a goodie, and it covers, I think, a lot of the areas that a due diligence item would request. So I think the small and mid-sized business community mostly is aware of a quality of earnings announcement or a financial based due diligence, and that's great, and there's value to add there. I think that they're egregiously expensive. When I hear some of what these analysis go for, $25,000, I don't know what the extent of them is. Maybe it's more than what I'm accustomed to, which is, looking at customers and the quality of their customers and their revenue share, which doesn't, to me, I just don't see how it would take that much time to do those things. But maybe it's the value-based thing, and maybe there's something that I'm missing. Please feel free to educate me, because I've done, I've been on the side, I've been on the buy side and the sell side, and yes, I've worked for firms that have charged that amount of money, but it's generally because like a partner's hitting it, and with a huge hourly rate, and it's just a bill code that just keeps getting hammered. But I think if you were to be efficient about it and be responsible, that you could get these things done for a lot cheaper, and get the same amount of value. So now when I do these things, and if you look at my firm website, I used to advertise this a lot, but it's become something that I like to do. But right now, we've put a big focus on our bread and butter, which is the traditional tax and accounting side. And then I do a few projects of these a year, whether it's valuations or issue items, diligence items. I do, maybe 2 or 3, and that's how I get my hourly billing goals, or, that's how I make my consulting money throughout the year. But it's not something it's always comes through referral or word of mouth, because I'm not promoting it a lot. But I want to share this because I believe that it was Ben that in the SMB community that said, hey, I should do this. And I wanted to take his advice and go out and to do this. So thank you, Ben. And thank you, SMB Twitter. You guys have been great, very supportive. Love you all. All right, so let's get into this. So there's a couple of areas when it comes to due diligence, all right? And I've mentioned a little bit about the due diligence that refers to, that most people are accustomed to, which is the quality of earnings, financial side diligence. I'm going to talk a little bit about my approach and what I do. So someone hires me, they want to buy, this is a, well, we were actually on the sell side. So this is a buy side issue items list, but I do leverage this for my issue items list. Okay. Couple of things they want to know. Hey, is the valuation fair? Well, as I know, value is what someone's willing to pay. Knowing what a fair market value is a good benchmark. It helps orient yourself, like to know where you're at. Are you overpaying or underpaying? But it's usually does not have a huge weight on ultimately what a business is transacted for. But I will tell you how I'll use this, because I will use the valuation that they have provided. So, let's think about, we're talking about a business that's provided with a broker. And so they do a valuation, which is generally cookie cutter. And so they have their SDE seller's discretionary earnings and their multiple, and they present that to you. And so I would use that and leverage that, because now we can, it's something that they put together. It's how they assess their value. So I like to use that in a way that benefits whoever I'm representing. And what I do with that is, if I can find some areas that we need to adjust on discretionary earnings or anything like that, or tax issues that are going to impact that cash flow, then I'll say, look, we'll give you the same multiple, but let's use this different cash flow, and should be an adjustment. And I've done that before, and it has worked, because it's their valuation, it's their basis, it's their logic. And so if there are adjustments that need to be made, and we say, we'll give you everything that you've already done, we just want to use this new cash flow that we calculated, they've gone for it. So, where do those adjustments come from? Well, they come from challenging the add backs, verifying all of those things. That's, I would say, more financial side, but they also come on the tax side. So tax, there's different levels of exposure. You have your federal tax, you have your sales tax, you have your property tax, you have your state sales and use tax. And I'm not sure if I mentioned payroll, but you have your payroll taxes. So there's all these buckets of taxes that you need to look at, that the business was responsible for paying. And I've done some research. I always have to refresh myself, but Texas, whether it's an asset purchase or a stock purchase, it looks like the liability is attached. So it's not something that you can just get away with. If the prior owner did not take care of these things, it's not something that you can transact and say, hey, I'm clean and clear. You have some responsibility for that. And I think that there's an opinion out there that if it's an asset purchase, that it doesn't matter or doesn't attach, but you need to look at your specific state. Texas is a state that those liabilities do attach, irrespective of how you transact it. So taxes are important. One, we want to adjust the cash flow, but two, we also don't want to be exposed or have any exposure with regards to taxes that the prior owner was responsible for but didn't take care of. So if you look at issue items discussions, we have some just general level risk things like, does the election made properly? And if it's not, what does that mean? We're talking risk right here, not necessarily can quantify it, but this is risk items. Maybe it comes, there's a dollar value associated with this risk, but there's definitely an impact to risk rate, multiple, because this thing hasn't been addressed. So, just general knowledge or theory of acquiring a business, less risky businesses are going to have higher multiples. They're going to be worth more. More risky business are going to be worth less, because risk is driving that. And so that's what some of these items are hitting at. It's like a risk item. It's like, well, this wasn't taken care of, that increases risk. But some of them are also data driven. So like property taxes. So this is a really easy one to get. Is most business underreport their property. They underreport their value of their property. And so you drill this big time, and which is you go and restate their property, go back in Texas, it's 7 years of statute of limitations, go back, look at what they prepared as their property, and then make an adjustment. So here's like $90,000 that needs to be accounted for. We're going to adjust the sales price. We're going to put this in escrow. How is this going? How did this impact your seller's discretionary earnings and therefore your valuation? $90,000 right there. In Texas, we don't have a income tax, but we have a margin tax. Here's another area. Did they do it correctly? Did they use the right methods? You would do the same thing on federal tax, which is not a big issue here because they don't pay taxes at the federal level. But if they did, like a C Corp, this would come into play. So in this situation, we found that, that there was $20,000 of exposure. So now we're at $100,000, right? That somehow needs to be taken into consideration. I tell people this is like getting an inspection on a house that you buy, right? You go in, you go find things. Hey, here are these issues. What are you going to do about it? It's a negotiation thing. And so it's what's normal and customary. This is normal and customary. And at this stage that we're doing it, I mentioned that it can happen pre-LOI or after LOI. After LOI and deep into the time span of the transaction, it works for you because you've already invested so much time. They've invested so much time. So, are they going to balk over $100,000 of adjustments at the end of the deal, knowing that this is just going to come up again, right? Maybe, maybe not. So it's all negotiation. Generally, when these things happen, adjustments happen. You get your money back. So if you pay someone $10,000, $15,000 to do this analysis, hopefully they find at least that in issue items, and you get that back somehow, some way. Risk item, methods of accounting. Audit. There's some risk. Is this closed? What were the issues? Did they fix them? So, you want to have some peace of mind when you go to bed. You can get a tax clearance letter here in Texas that will make you free and clear. But hey, just something to point out. Issue items again. So, there's another item here. I don't know if it came up with 36,000. I want to say it was like built-in gains. Yeah. So some inherent deferral of taxes was in this section here, which was 140,000. So we're at what? Almost $240,000 of exposure. What are they going to do with it? This buyer was okay with saying, "Hey, we'll put this in escrow until these statutes run off." So they didn't get their money right away, but the buyer was protected. What I like to ideally see is some type of in the middle, like, "Hey, you're clear. I found this, but we're clean and clear. We're going to adjust the price based upon these issue items. So we're going to go down $100,000, $150,000, and we're good." That's the ideal situation, and it has happened. I think the biggest issue items result that I've had with respect to the deals that I work on was in excess of $300,000 where they adjusted the purchase price. I think I way undercharged for that, which was like $7,500. So, which brings me to the last thing. How much does this cost? Well, if you're working with a regional firm, it's going to cost $150,000 for something like this. Minimum 25 to 45,000. I'm not, that's not what I do, because I really scope the items in respect to the areas that I like to focus on, which I feel like are the areas that have the biggest bang for the buck. And so, I'm around, I'd say like 10 to 15,000 is where I typically like to come in. Smaller deals, I mean, there's some deals that are really, really small. I can do them for $5,000 to $6,000. So I hope that you learned something, and that the next time you go into a deal, that you think about these items, not just on the financial side and the quality of earnings, but you think about the tax ramifications and how they can favorably benefit you. All right, guys. God bless. Hope to meet and talk to some more of you in the future. And again, hope you enjoyed this. Thank you.